Hello and welcome back to Easy Finance. In this video, we're diving into the revenue recognition principle, one of the core concepts in financial accounting. Understanding this principle is essential for preparing financial statements correctly and acing your exams. By the end of this video, you will know exactly when to recognize revenue and why timing is so important. So, let's get started. The revenue recognition principle states that revenue should be recorded in the accounting period when it's earned, not necessarily when cash is received. In simpler terms, if a company has delivered goods or provided services and there's a reasonable expectation of payment, the revenue can be recognized. This principle is a key part of accrual accounting, which most businesses use to provide an accurate picture of their financial performance. Why is this principle so important? Without it, companies could manipulate their income statements by recording revenue whenever it suits them, making profits look higher or lower than they actually are. By following the revenue recognition principle, financial statements more accurately reflect the company's true performance in any given period. Imagine a company sells $10,000 worth of computers in March, but the customer pays in April. Under cash accounting, revenue would only be recorded in April when the cash is received. Under the revenue recognition principle, revenue is recorded in March because that's when the computers were delivered and the company earned the revenue. This ensures March income statements reflect the actual performance of the business. Another example is, consider a marketing agency that signs a 6-month contract worth of $30,000 paid upfront in January. Even though the cash is received immediately, the revenue cannot be recorded all at once. Instead, the agency recognizes $5,000 each month as services are delivered. This matches revenue with the period when the work is actually performed, providing a realistic view of profitability over time. Think of yourself. You for sure have a Netflix or Amazon Prime subscription. You pay upfront $120 for a 1-year subscription. Netflix cannot record the entire $120 as revenue immediately. Instead, it recognizes $10 each month, corresponding to the period when the service is provided. The remaining balance is recorded as unearned revenue, a liability, until the service is delivered. This example highlights how the principle prevents overstating revenue and ensures revenue matches service delivery. The revenue recognition principle works hand in hand with the matching principle. Revenue is recognized when earned, and related expenses are recorded in the same period. For example, if a company earns $100,000 from selling goods in March, the cost of producing those goods is also recorded in March, even if cash changes hands at a different time. Together, these principles form the backbone of accrual accounting. For your exams, remember these key points. First, revenue is recorded when the product is delivered or the service is performed. Also, revenue can be recognized if there is a reasonable expectation of payment. Don't confuse cash collection with revenue recognition. And watch for subscription, prepaid services, or long-term contract scenarios. These often test unearned revenue or percentage of completion accounting. To summarize, the revenue recognition principles ensure revenue is recorded when earned, not just when cash is received. This principle guarantees that financial statements provide an accurate, fair view of a company's performance. If this video helped you, like the video, leave a comment with your question, and subscribe to Easy Finance for more clear exam-focused accounting tutorials. Thank you for watching, and see you in the next video. Bye bye!